Hey, what's up, everybody? Tuesday, October 8th. Market is down about 300 as of this video that I am recording right now. Now, if you go back, I don't know what, about 10 days, 2 weeks, I was putting up videos saying that I am cautious or negative on the market. As a matter of fact, I had some of you posting up comments like, oh man, he's actually putting up a bearish video. But I was at the time talking about the Fed's monetary operations, specifically these repos that they are doing, the rebuilding of the Fed's balance sheet, the pumping of reserves into the banking system, and I said that would be short-term negative for risk assets. And we were also getting into that trough in the reserve cycle. And from the trough, what happens? You get a rebuilding and as the government spends, and that was negative just on its own. That was a bearish cycle just on its own. These things fluctuate month to month, or every 6 weeks or so. But on top of that, and what made me more bearish than usual, was the Fed's monetary operations. Now, this all came about, if you recall, in response to the fact that the Fed probably had taken reserve balances down too low relative in September, late August, early September. Reserve balances in the system had gone down too low relative to the quantity of deposits in the banking system. Remember, there's a 10-to-1 deposit ratio, a 10% deposit ratio. Banks have to hold 10% of reserves against their deposits. We have 13 trillion in deposits. Reserve balances got down to about 1.3 trillion. So there you were. They were right at that 10% threshold. There were no excess reserves. Now, the big problem, and this is all this stuff is really a regulatory issue that could be solved by the stroke of a pen. Instead of we're having this ridiculous, these extreme monetary operations that are causing a lot of disruption in the financial markets. I mean, all this could go away with the stroke of a pen. These are regulatory issues, and I believe that Congress actually gave the Fed authorization to fix these problems, but they're just sitting on their hands. And again, part of the blame goes to the Powell Fed, which is the worst, but it also, I believe, goes back to Yellen, if I'm not mistaken, in the very last part of her term. Whatever. So yeah, in late August, early September, reserve balances got down to a threshold that was too low. They basically engineered the system short of reserves. There were no excess reserves. And what I was going to say was about 5 banks, the major banks, hold the vast majority of reserves. And they were squeezing everybody. So the smaller banks, that's why you saw the overnight lending rate shot up above the Fed's target. So they had to come in and correct this. They had to come in and rectify this, and they did. I mean, they brought reserve balances as of last Wednesday. They were at 1.485 trillion. So 185 billion over, let's say, where deposits are right now. They've been adding more. But now, Friday, just the past Friday, they said, oh, we're going to keep doing this stuff now. This stuff was supposed to end this week, right? It was supposed to end on Thursday, October 10th. Then they come out on Friday and they say, oh, we're just going to keep doing this till November 4th. And we're going to do 8 more 14-day term repos. We're going to do these 75 billion every single day. So I said yesterday, my back of the envelope calculations are going to add another 300 billion. Boom! Bearish. I sent out to my subscriber, that's why you got to be hooked up with what I'm doing. Guys, you got to be hooked up with what I'm doing. If nothing else, even if you don't trade, you have to understand, it's very I have people say, you know what, Mike, your service is fantastic, your service is excellent, but I don't trade, so I'm gonna cancel. Mistake. Big mistake. Knowledge is power. Information is power. Mental game. You know how many people have told me that my mental game instruction and tricks and tools that I teach have helped them in their lives generally? Has nothing to do with trading. So you have to understand what these flow. And by the way, if you're in business, if you run a business and you think you don't need this information, well, let me tell you, you are sadly mistaken. So anyway, that's what happened. The Fed said, well, we're going to keep it going. We're going to keep it going. Why? For what reason? Anyway, they're going to keep it going. It is, the analogy I've been using is with these massive reserve dumps swallowing a gigantic Thanksgiving dinner whole, the indigestion, the pain that will cause will be, something very, very real. And that's exactly what is happening in the banking system right now with this every single day incessant dumping of these reserves. And again, this whole entire thing could go away with the stroke of a pen, because we're really talking about a regulatory issue here, a regulatory problem that can be fixed. So it's really a shame. And I'll tell you why it's a shame. It's a shame because underlying this terrible policy by the central banks, and by the way, this is universal. If you look at what all these central banks are doing, not just here in the United States, in Europe with the ECB, the Bank of Japan, forget it. I mean, for 20 years now. And everywhere else, terrible, destructive, disruptive policy. But the good news here is that underlying all this, very, very powerful fiscal support. That remains in place. And that is really good for the real economy. However, these bozos at the Fed could really screw it up. People could look at the markets, they could get scared, they could curtail consumption, businesses, might pull back. You could get a negative effect off of this. I don't see it so far, but it can happen. Anyway, we're in this period. It's negative for risk assets. If you want to know when we're going to get out of this period, again, you got to go to my website, sign up for a 30-day free trial of MMT Trader. Go to pitbulleconomics.com. Folks, you need this information. You need this understanding. Absolutely, unequivocally, without question. Go there now. Bye.